Next panel is on business models. I did hear several business model questions in the previous panel. That is just fine because almost all the panelists have a very, very diverse experience. And this panel is, again, some of the best in the industry. I have the honor of moderating this panel and myself. So I will get started and get more quickly to immediately the questions and answers, questions you may have. I think business model question is the most important question entrepreneurs face. It is actually all about the business model. So I think as a result, you would find this panel to be extremely valuable to you. So I don't want to take any more time. I would like each of the panelists to simply introduce themselves and give their first thought on what they believe is an important element of the business model, and then we'll get over to the Q&A.
Hi, my name is Kumar Sripadam, and I was a serial entrepreneur turned investor, and one of my major exits was Redback Networks. Back in 2001, we IPO'd in 1999, and I was one of the early guys contributing into hardware and later on moved into marketing. Currently, I'm an active angel investor as well as work with a lot of startup companies and helping them do various stuff. Well, I would say business model is pretty much a blueprint for any company, but that's the academic definition, right? Business model for a startup is sort of completely different because, if you can really predict the unknown, that's pretty hard to do as a startup. And to me, a business model has to be a tested hypothesis, and it has to be a customer-tested hypothesis, which has been iterated and well-tested before you go out into the real world of making revenue.
My name is B.V. Jagadish, and I'm an entrepreneur myself as well. I did my first company in the 90s, Exodus Communications, which we took it public in late 90s, and then I did another company called NetScaler, which got acquired by Citrix in mid-2000s. So since then, I've been basically like an angel investor, and I have about 8 or 9 companies active. Most recently, I had a company called Nutanix that just went public, and had a bunch of other companies that had exit and failures as well. I think Kumar articulated it very well. This business plan is like a blueprint, and in fact, as an investor board, they would actually love to see this business plan changing almost on a quarterly or on a semi-annual basis, because you really want company to go through the exercise of building the business plan, and as the dynamics of the company is constantly changing, you would want this business plan to be changing on a regular basis. I would think, at the end of the day, investors in the early days, what they would be looking for would be one accurate reflection of the TAM and the SAM, which is the total addressable market and the serviceable addressable market, because there's a lot of distortion that the entrepreneurs really reflect these two things. So it's very, very important to nail down what exactly is the total addressable market for what you're doing, right? Don't try to exaggerate. Don't try to overdo and try to reflect that your market is a lot bigger than what it is. So bring it down to specifically to what your TAM and the SAM is. That's number one. And number two is the most simplistic way of articulating your value proposition, right? Of what the customer really gets from your product. And number three is the team. I mean, if you are in early stage, right, it's preferable that you have at least more than one person as part of your team. I would think these would be the three key criterias that people would be looking for before they encourage any further discussions.
Yeah, hi, I'm John Dougery, one of the founding partners at Inventus Capital. We're an early stage venture capital firm. I started in, early stage businesses way back in the PC days in the late 80s, and then through Sun and Silicon Graphics when they were big companies back in the early 90s. And went into venture in the mid 90s and started investing with Conwell Recchi, who at that time was one of the first super angels before there was such a thing. And he and I did a lot of investments together, very successful. He of course is one of the investors behind BV. And we started a firm, this firm Inventus, about 11 years ago. And we're very focused on the early stage, both enterprise and consumer technology startups. And yeah, I think it's been said very well. I think that the journey of discovery on price, on business model, is one of the most important aspects of starting a company in our experience. And one thing that I'd kick off that we look for is a team that really appreciates the need to understand the value proposition of the customer, the customer's perspective on the problem that's being solved, and really understanding that deeply is the core in our experience on how you price it, how you sell it, who you sell it to, and why. And it's a journey of discovery. So it's a constantly changing and pivoting problem. But if you're a team that is just maniacally focused on understanding that as you go through that journey, then your pricing will also usually follows very logically from that.
So my name is Rohit. Most of my companies have been in a space which is very commonsensical ideas that I've built them on, and they've challenged business models. So anything to do with challenging business models is very interesting to me, especially when we challenge common wisdom with acquisitions like companies like WhatsApp, which have no business models and then get acquired for billions and billions of dollars. So the fundamental question I would love to get an answer from the panel is, what are name two very disruptive business model companies that you've seen without having an intersect across the responses, if you will?
Let me take a couple of examples. One of the things that I'm actually pretty fascinated, which I have been studying over the last several years, this company called Ubiquiti Networks. If you guys actually study, this is a public company with over $500 million or so of revenue. This is a company, if you study their S1s and the financial statements, because it's all public, right? Majority of the employees in this company are all engineers. And the amount of dollars they spend on sales and maybe even marketing is probably very minimal. I mean, for a $500 million company, the money they spend on sales and marketing is like, less than 100K, right? So this is absolutely fascinating, the way how this entrepreneur has built this company. And I would love to work with an entrepreneur who is willing to build a company like this. So, because he believes that when you have hundreds of these channel partners and massive distribution, which basically taps into thousands and thousands of salespeople, why the heck we have to build sales teams, right? Which is the biggest expense in early stages of the company. So which means, as I'm building the company, the most important thing, right, is to build a product where the value proposition is simple, and build a product where I can deploy the product, I can service the product, right, very easily. So the whole philosophy of building the product so that the distribution can sell and service ahead of time, right, is pretty fascinating. And he has proved, as an example, that you can viably build a business model. And if you study this company, the gross margin that he gets from these distributors is only 40%. And if you look at his operating margins, it's 30%. So that means he runs the whole company in that 10%. And distribution can actually sell at whatever the market can afford to pay, right? All that he says is, this is my bill of material, this is my cost, and I want 40% margin, right? And I know how to run my business. And you can sell at whatever price you want as long as the market can afford to pay. I don't care, right? And the numbers are absolutely staggering. It is astounding to see someone in this era has completely leveraged the power of the distribution and channel to sell these products through that. I'm actually very fascinated. In fact, I speak to many entrepreneurs to see, if we can build a company, a product that leverages the distribution right from day one.
Okay, let me, Kumar answer. Yeah, Kumar, then John.
I want to take a slightly different approach. And I came from a hardware background, and where vaporware was no. And then we come into this era of so much of social products, social enterprise, and all of a sudden you have billion-dollar valuations for all these companies that you can think of. And I was just reading something recently, and one company comes to mind, Pinterest, right? And correct me if I'm wrong, I'm still struggling to figure out the business model on this one. And close to raising $11 billion. Twitter probably raised $12 billion. And, so some of these things are, maybe it's organic membership growth and comes to a point where there's so much of value created with people using it. And there is a good instance of that, it's Facebook. And they were able to channelize it really well, right? But there are few of them. There are not going to be so many. That's one thing I think everybody should understand. And the second one is, Twitter is still struggling, trying to figure this out, right? So my take on this is we have to tread real cautious in this, disruptive business models, and make sure that, we do have support from all sources, whether it is ad-supported, and which ad-supported, by the way, is sort of, as a source of income is going down, okay? And I think the best possible answer, again, for the WhatsApp example which you gave is again, it was a threat. And I think Facebook took it as a threat, and that became a sort of a disruption by itself. So,
but the value proposition was very simple, though. Very, very obvious with WhatsApp.
Yeah. John?
Yeah, and you see what WhatsApp's, we invest in India too, and it's starting to be a platform for commerce in India that's really spectacular, connecting not just the consumers, but the businesses with consumers. So, WhatsApp could turn into a very interesting kind of enterprise or small, medium business enabler.
There are a couple of companies which actually are starting to use the WhatsApp as a narrowband, and they're using WhatsApp to deliver quotes and simple making e-commerce transactions through the WhatsApp channel.
Yep.
So they're building it on WhatsApp. So
people are able to buy their groceries from their corner store, and they're in India, via WhatsApp. It's really quite something.
The company's name is Duta, like Mega Duta.
So, you'd asked about business models. The obvious one might be Google, right? You go way back. You say, was Google successful because of its algorithm or because of its business model? And I think it's a raging debate that probably doesn't have a fine answer at the end. But you look at that. It's kind of like Pinterest. How the heck do they make money? I remember in the late 90s when I first went on there, and I thought, this isn't Yahoo. I don't have any display ads. How's this company viable? And yet, behind the scenes, they had an advertising model that was very innovative, a very innovative business model. And I think any of these consumer types of names and brands that have been discussed, you're talking about really big plays. These are home runs or they're nothing, right? And that's why you see that consumer outcomes in venture are either really big or very, very disappointing, because you have to aggregate a huge audience. And I think that's where Twitter's kind of caught in between, right? I don't know how many people in here are on Twitter every day, but their user growth has really stagnated, and that's been a big problem. But if you look at enterprise business models, I think BV with Exodus was at kind of the early stage. I came out of the hardware business too, and it was all about hard products. I have a product, here's the price, you pay me, I have a gross margin. A very simple business model, right? Well understood. And then you've got Exodus that basically took all that hardware and sold it as a service. And the whole idea of hosting the infrastructure, the bandwidth, and that. Then you see Benioff doing that with software as a service. And the latest thing I'm seeing now is really interesting is this dynamic service pricing model. All those prices were relatively steady state, right? Here's my price list for whatever number of racks or whatever amount of software or users of software you want. You pick it up and you just multiply it by the number of users. Today, we're looking at companies that are able to dynamically price based on ROI for the customer. So this kind of goes back to my opening comment about if you really understand what the benefit to the customer is, your best price is probably to split that difference with them, right? Say, okay, I'm going to give you $100 of benefit, why don't you pay me 50 of it? How do you do that? And especially when the benefit's different from one customer to the next. So a dynamic pricing model that is actually variable based on the customer success is, I think, the next step that could be really interesting in this kind of, anything as a service kind of business model.
Thank you.
Okay, I'm Afzal Hussain. I'm an entrepreneur. Very simple question, actually. So I will phrase the question, but let me give just a small introduction. When the engineers become entrepreneurs, a technologist basically went to a engineering college for several years and then turning into an entrepreneur, write his first business plan. And the first question he hears from the people who would be a potential the investor is that I don't see any business, because he look at the face of that entrepreneur and look at the engineers and no business background. So help me understand with a definition, simple definition, what is a business model, and is it part of a business plan, or is it the same thing as a business plan? Thank you.
I think that business model is the kind of mathematical statement of the value proposition. How am I going to price it? How am I going to sell it? It is, to me, it's much more about the go-to-market part of a business plan than say, the product or the technology. Right. And I think that's often the battle. A lot of entrepreneurs are thinking about a technology that they know very well, and they know how to apply it to an area of the market that no one's applying it to. But you got to go that next step to say, okay, but what is that end value proposition? How much am I saving that customer, either in their business process or cost or enabling in terms of revenue? You got to be able to quantify that, and then that's where your pricing and everything comes from, and that's the business model versus the product, right?
No, and the plan is it's basically completeness of your thought process, as Kumar was saying. It's a blueprint, right? So what do you require to run your business? Do you require customer support? Do you require direct sales? Do you require channel? Do you require marketing? All of these things. So it's a validation of the thought process, right, as to how you're going to bring your product to the market, and what kind of personnel would be needed, and how many engineers are needed to produce this product. Right? That is the whole thought process, which becomes the business plan, and with the business model of how you will bring this into the market.
Yeah, let me just quickly, just by analogy, since you guys are engineers, business model is the architecture and plan is the engineering that you do if you're building a building. Actually, that's the way to think about it.
I'll even take it a step further. Academically, business plan is the entire thing. I mean, if someone asks you for a business plan, you're going to include everything. It's your team, it's your product, it's your sales, it's the whole thing someone asks you for. But the business model is how does your product solve a customer's problem, and how is that going to generate revenue, and how is that going to make profit? That's in all. That's what a business model is.
Hi, Brian Zonsticker, Power Rocks. So I run a power electronics consulting firm here in the Valley, and just since a couple of you guys identified yourself as hardware folks, I think you're uniquely positioned as a tragically endangered species here. Perhaps.
Exactly.
So, to answer, uniquely positioned to answer this question, right, is especially as a power electronics person, I'm always trying to convince people of the importance of, even power, which is the red-headed stepchild of even hardware, let alone hardware being the red-headed stepchild of the technology world, right? And as we've gone from hardware companies to software and services companies to cloud services companies, how do you bridge this gap to still make folks like yourselves that aren't hardware biased to understand the importance, whether it's risk mitigation or the probability of success, even in a software apps, cloud services based type of industry, that that, even proactive planning, not dealing with it when it's a problem, but proactive planning and investment in the hardware space, power, which I'm biased to, right, has a true value that has to be invested in as a critical resource up front, right? Because if guys like me don't give up and just finally get rid of it, guys like me go away, there's nothing for any of you guys' stuff to run on. So
it's not really true that, I don't know, you may be able to answer this. Actually, I'm involved with a company that has produced a hardware product. I mean, as much as these guys are, I also believe in hardware products. So it's not just hardware, right? It's a combination of hardware, software, and what the ultimate solution and what the problem that you are solving to the customer, and whether the market is willing to pay, right, for the cost of the hardware and the margins associated with the eventual product that you're going to sell to the market. So I think that's where it comes down to. I mean, I don't know if people are really focusing only on software aspect only, which I don't agree fully. I do believe that there is market if you build the right hardware software combination, and I'll be happy to actually take you through the company that I'm involved with, and it's pretty fascinating, and there is a lot of hardware component, including some of the power electronics that you're talking about.
Going back to business models and business plans, just out of curiosity, in all the companies that you've seen, how long do the original business models or the business plans survive as they were originally constructed?
It's a journey, and most investors understand that, and most entrepreneurs find that out if they don't understand it. What you're trying to, especially at the early stage, you're trying to get customer engagement. I think there was on the prior panel a question about how do I go for high price and low volume, or low price and high volume, and the two are not necessarily mutually exclusive in the end. But we have a company right now that's basically getting as many. It's a consumer adopted enterprise service, so it's kind of adopted by the end users in these enterprises, and they're finding that once they do the histogram, have a large enough, significant number enough customers, they're finding that there are certain segments that will pay $5 a month, and there's another segment that's going to pay $19.95. And guess what we're focused on, right? We're going after that $19.95, as we're finding that could be a very big vertical slice and replicable company to company. But it took them a year and a half to figure that out. So they started out thinking, we're going to sell this for $2, and we're going to do a freemium, and now it's completely shifting, but that was by design. That was always expected, and I think I think it was set up front that you're innovating it every month, every quarter, and it's a journey.
Including, even if you miss the numbers, as long as you understand why you missed the numbers, and as long as you can articulate to your investors and to the board, right, as to why you missed the numbers, either on the expense side or on the revenue side, right? If you can actually articulate that, because most people understand, and most people who build companies, especially in Silicon Valley, who are on the board, they really understand that this is part of the journey, right? There's no surprise in this thing. But key question is, do you understand why you missed it? I think that is the most important question that you as an entrepreneur need to answer.
I think the best answer to that is when you get a feedback from the customer saying that you're actually solving their problem, right? So the hypothesis which turned into a MVP, or a minimum viable product, which you took it out to the customer, and the customer says, yes, this does solve the problem, it adds business value, and now you've got something to work with. And that is your first step to your business model, which is going to develop and become bigger. So you would take that as I equals 0 for your business model. And that would start to grow as your engineering works with you, and you make the product full-featured, fully functional to meet the customers and increase the customer base, and then generate revenue stream. So you need to get that initial seed right. And that would be the time, whatever the time it takes, whether it's iterative, and if you're going to pivot, and you might as well pivot, whatever it takes. And that would be the one which would give you the answer, So it's not finite. You can't, just say that, yeah, it's going to happen 6 months. As BB said, I mean, it can be anything. So as long as you get it right, you got to get it right.
Hi. My name is Preeti Jaram. I help build strategy for this company called Opia Health. We're a digital health company. So I had a quick question about the business plan and the business models you were speaking about. So at an early stage, when we're speaking to new investors, we're speaking to new clients, when we send them a small pitch deck we were advised many times to restrict our slides to like 10 to 15 and speak at minimum, but make an impact. So how do you think early stage startups can start doing that when you don't want to communicate too much and at the same time don't want to be misunderstood?
I think the challenge of being succinct, which is what we're facing here, more you know, more you master your business model, you will find you can communicate it in smaller number of words. It is actually your own uncertainty about what the future is that requires so many words to explain. And that's what we are looking for. When I'm looking to somebody, their conviction, their clarity shows up in the first 30 seconds or first minute. And that's the power. That's a challenge, I know, but that's what you need to learn to build.
So it is advised that you actually do customer validation and get confirmation from the customer that they will pay X amount if I build this product. Now, in your opinion, how many customers are ideally enough for such pre-product or even pre-prototype validation to start building the product?
If you have anywhere from 3 to 5, that would be ideal. I've also seen some companies where they've actually built the prototype, and prototype is being validated by a couple of these customers as well. That further even validates the idea and the value proposition. Ultimately, I think it's the value proposition and the simplicity of that value proposition and what the customer would pay for that. Yep. So can you build a viable business eventually, for that value proposition and the money that you make out of it?
John, is that a different answer for consumer product? This is enterprise-oriented answer, which makes it very clear, yes.
Right. Well, there's that's a good question, Satish. And we're seeing a tremendous blend of those two models now because so much of enterprise is being adopted by the end user, not by the CIO, not by the IT group anymore. And so, we do a lot of enterprise startups, but a lot of my partners in the consumer side are leading those investments because the biggest critical factor is how do I get in the market there? How do I, get the purchase order one credit card at a time within this company? So we've got a company that's penetrating Walmart like crazy, but it's all through the back door. It's all through people buying one at a time. The other part of your question, I think, is it's not about necessarily pricing either. I think it's about engagement. You want that customer to be iterating with you early, even before you've built the product. If you can, if you have the chops, if you have the relationships, you should get them involved. We see so many entrepreneurs spend 6 months heads down engineering something only to find out that they should have pivoted 3 months earlier in a slightly different direction to hit what the customer really needs. And so that has nothing to do with what the investor needs. It's everything to do with the right process for you, I think.
So many of you have been in many ventures. Some have gone well and some have not gone well. Let's say a few of us over here come with great presentations and convince you to invest and so on, right? But beyond that, what's the 3 red flags that you look for to see which among us will succeed and which will fail on a periodic basis in your evaluation?
What we're always trying to, and this kind of even goes to the lady's question earlier about the 10-slide pitch. We're always looking for that clarity of thought, right, and the clear focus on the customer versus the focus on the product or the technology. And if people start to go down that road, then that means they're having a hard time understanding the customer or the market, or maybe they're hearing things they don't want to. So we always, and they just think, I'm going to build it, they will come, don't worry about it. So we're always, our antenna are always up for that. So that's one big area, that we're always trying to help our teams understand and stay out of that trap of just focusing on technology for its own sake. I think an issue of fairness amongst the team members is also another thing that comes up, time and again in the evolution of a company. Is there leadership and is there fairness? Where if there's a leader has to take the blame as well, and not just the credit, right? And has to share the the results with the team. So we look at how is the stock being shared, how is the credit being shared, how is that behavior in board meetings and management meetings? Is everybody allowed a voice, or is there an overbearing voice in the room? I think in an early stage company, that's really critical. So those are at least two things that we try and focus on.
If I can basically visualize, right, why companies fail. Post, you go through all these things and you get the funding. Still, a lot of companies actually fail. I think the number one reason why many companies fail is on the execution front. I think either they don't visualize the complexity of the product and listening to the customers regularly to bring in the product that the market actually wants. So either you bring like a half-baked product and introduce or try to introduce into the market, and as you try to install that product in a customer environment, you have not thought through, right? Many of the complex ecosystem that you need to plug your product into. So if you initially excited the customer with the value proposition and you actually take the product and the product is a misfit in that environment, then that excitement is lost. And you don't know, whether the same excitement will last when you come back after fixing all the product. And that could be 6 months, 1 year, 1.5 years, who knows. So a lot of times, that is the reason as to why many companies would actually start failing. And that leads to other issues like you run out of money. So when you run out of money, if you have not demonstrated the value proposition to the customer, or you have not demonstrated customer traction and things like that, right? It'll be hard for you to raise the next round of funding. So typically the way the VCs work is they don't want to continue to keep funding the same company, right? And especially if a company has not executed well or failed on the execution front, then they want someone else to validate this idea. And if that someone else is not willing to step up to fund the company, then you run out of money. So these are typically the reasons. So, execution is the key, which means did you constantly listen to the customer? Did you hire the right set of people? Did you build a good quality product? Did you build a product with all the features and functionalities that the customers wanted? I think, it comes down to all of these things. And if there is a mismatch, then that's when you start seeing the challenges.
I just want to add one point is, I think BB and John gave out really good points on this, is when you start going away from the lean model too fast, you're going away, your spending has increased, your resources have increased, but your returns have not come in. And then suddenly you find that you're short of, the runway is short, and you're not able to raise money in the time which you need to raise money. Then what do you do? And that's the point when you need to go back to your core. You need to go back and say what worked, and let me start going back to that process and go back and become a lean machine again and start executing. So at least you can save it from failing. Because if you take from the VC perspective or even any investor perspective, nobody's going to put good money after bad money. I mean, they're going to say, okay, well, I'm going to write it off and move on to the next one. So I'm just going to end with that.
My name is Ravi, and I'm a founder for Audit Prodigy. And is there a technology bias here in terms of how you invest in projects which are not necessarily a cure for cancer, but more like cure for common cold? These are old problems that existed for a long time, and you have a new take on it. Is there a certain bias towards the latest cure for cancer kind of angle? And I also have a second question, if you don't mind, is when you're going early in the market, you get pulled by the customers sometimes. You may have a vision in a specific segment, but when you start showing it to customers, some of them, not customers necessarily, prospects, they start pulling you in a different direction. They start saying, we can use this for something else. And then you're conflicted. Do you want to stick with what you started out with, or do you move with what your prospects are telling you to move? Do you see that situation quite a bit, and how do you handle that?
Let me,
Technology bias, I'm not sure. I think it all comes down to, what problem you're solving, what value are you offering. I don't really care, what technology that you really have, as long as there is some differential, right? So that someone else doesn't just copy and produce what you're doing, right? So there has to be some intellectual property. I think in terms of the other question that you said, I'm not a big proponent to say yes to everything that different markets, different segments are asking. But if you have determined that the first target market that you went after is not probably the right market, and you have to go after other markets, I think that should be fine. But I wouldn't recommend that day one you go and start addressing, which is basically boiling the ocean, right?
Yeah.
Because then you cannot succeed.
Right.
So the whole success of startup companies is about focus. Because you don't have the resources in terms of people, money, and everything. So whatever you have, you got to just nail it down to the market and the product features and functionalities that fits that market. You just cannot boil the ocean when you are a young company.
let me, just a quick comment on that. I mean, the cure for common cold, I mean, you're talking about like a generic problem. And so what I'm saying by that is, if it's a big Me Too, you're a Me Too company, it's a big market, then sure you can go after. And we look at a lot of Me Too deals as well, but as long as you have the right differentiator, as long as you have your secret sauce, which makes sense, then you have a piece of this huge TAM or SAM or whatever you call it, then yeah, it's okay. And then coming to that second question, recently, I mean, you know, it's surprising that you say that. We just went through this with a company I'm working with. As the company did this product, they came up with this byproduct which these customers want, and it's so hot and sexy that they really want it, that somebody is willing to write a check, but they want this to be done separately as a separate entity. They don't want it part of this company. So we went through the motions of the whole thing, and so one of the guys is going to branch off. One of the head honchos there is going to branch off, start another gig completely, and there's going to be two separate companies, one doing the mainstream, the other is going to do the byproduct. So, and that's the only way you can get focus, as what BB has said.
Hi, I'm Mayukini. I'm the co-founder of Opia, where we make both hardware and software to make plant care easier for busy urban professionals like self-watering systems and all that. So we had a similar experience as what, John, you were talking about, where we had to make a choice between making sort of half-baked products that you could sell at really low $2 kind of a cost versus niche premium products that would, you know, sort of reduce our audience to those who could appreciate that kind of a full-fledged experience, but you know they would be willing to. They appreciate, you know, their plants being sort of nice and healthy and beautiful, sort of setup. So we made that choice, which was you know, to go for premium positioning rather than, and our margins were pretty good in that as well. Now the question really is, so. We are at a stage where we are proving this hypothesis that this, you know, people are willing to pay for a product like that. Does going niche sort of diminish our chances of, you know, and premium of showing that kind of a scale? The hypothesis is that once these early adopters sort of set a trend for it, it can go mass. But does it reduce our chances of sort of showing that kind of a scale at some point in time? Yeah.
Well, yeah, it's in your particular case, you've got hardware involved, so there's a manufacturing cost, there's a hard cost to it, right? So you have margins, which again sounds like you made a good choice from what you've said, that you go premium, you're getting better margin, which for a new product or a new commercialization of technology is generally the best way to go. And then as you can reduce that cost, you can start to move down the market right? Hopefully. And go for the other volume markets. Some of the examples we think about are more software oriented, so it's really not about, you're not driven by a margin question, it's more about, where can I get the best return on sales, or where am I going to get the most engaged customer that's going to help me learn so that then I can understand the broader market that may not know what they need, right? They're less often engaged, and so those kind of customers are hard because they can't tell you what they need, but they know it when they see it. So that early adopter generally figures that out, and then you can productize that, and everybody says, oh, gee, of course I needed that. So there are a lot of reasons why that model is the most popular in finding that initial premium segment. For you, it's going to be about cost reduction, I imagine, because you still want to sell at a good margin, whatever segment you're going after, right?
Thank you very much, and of course, I thank very much the panel. This is for their time and sharing their wisdom. Thanks a lot, guys. Thank you.